Hi, my name is Sherwood Robbins. I'm the Managing Director of Seedcopa, PA, and I just wanted to take a few minutes today to go through a PowerPoint presentation about different federal loan programs, what we call tools in the toolbox. And just a little bit about my company itself, Seedcopa, PA. We're what they call a certified development company, and what we've done is spent over the last 30 years working with business borrowers and utilizing federal, state, and local loan programs to either be a complement to or an alternative to other financial offerings such as a bank loan, etc. We work throughout the Commonwealth of Pennsylvania. We work with over 35 different banks and over 14 different economic development partners such as Northeastern Pennsylvania Manufacturers and Employers Association, and we have good partnerships there, and we try to work on webinars like this to make people aware of these programs. My staff, I'm very proud of this, is between 8 of us, we have over 70 years of combined dedicated government lending experience. And just on to the expectations. I think anytime you're working on a commercial loan project, I think the best thing to be aware of is as a communication and expectation is if everybody ends up on the same page, it doesn't have any 11th hour surprises, which is the much better way of working on things. So just communicate often, and I definitely, as we go through here, won't be reading bullet by bullet, but touching on some of those. As far as the loan processing, you want to have an understanding of how the bank or the partner that you're working through for the loan is what is their process, what's their timeline, how long will this take. If you're on a shorter wavelength and they're on a longer wavelength, you want to make sure you're speaking that same language. Is there anyone else need to be involved? Is there a township or a community that needs to be involved, organization? Is there an appraisal or an environmental? And then working on completing critical documents early and often. So again, that appraisal, environmental, if there's going to be an issue and the environmental is going to take a longer time, we just want to know that from the beginning, and so would you. All of this to avoid really the idea of avoiding delays and duplications with each other. On the government loan program basics, and again, this isn't exacting. There's obviously some variances to this, but overall, the program specifically that we'll be talking about today, we're talking about for-profit businesses. While we do have nonprofit opportunities, they're lesser, or they might be more specialized. So that's something that we could always just talk about. For the most part, though, think for-profit businesses. We are talking about not being investment properties, so about owner-occupied properties, but again, I have there discuss investments. So we do have some loan programs that can work on investments, but for the most part, what we talk about today is businesses where the operating company or your own business will occupy 51% or greater of the square footage of the property. We could talk about outdoor occupancy, so someone like a mechanical contractor or an electrical contractor who has a big fleet of vehicles, they might need, and that outdoor parking space is very important to them in addition to the under roof square footage. There is a new construction requirement. You have to occupy a little bit greater, up to 60 to 80% of the square footage over time. But again, that's for new construction projects only. Machinery and equipment, nice part is we can go up to a useful life of 10 plus years depending on what we're purchasing. For the most part, most industries and projects are eligible. We have to talk about whether they underwrite or not. So something like a solar project definitely could make sense. It's eligible, it's available for financing. We might have a situation where the amount of the project to install solar panels might not increase the appraisal by that amount, so we'd have to just talk about does that underwrite, but it definitely would be eligible. When it does come to underwriting, we just want to talk about does the project make sense? Do you have enough money once you get into this project? Do you have adequate working capital, enough money to actually run the business once you're in the property? And again, we just want to make sound business summaries and projections. So if someone's growing and they're going to grow, we don't want to be outrageous growth. We want to be realistic and something that could be attainable. And again, all of these programs do not make bad loans good loans. So on to one of the loan programs. The SBA is the Small Business Administration. It's a federal program. The letter and number of the loan 7A is just through the policy that it was released through, and this goes back to the 1950s, this program. So this program overall is what they call a deficiency guarantee program. And essentially what that means is if the business were to ever fail, the bank or financial institution using this program can go back to the federal government, the SBA, and collect a portion of their money in the form of a guarantee, between 75 or 85%. Collateral requirements, again, this is one where the program requires that we secure both business assets and, if appropriate, and only if appropriate, personal assets. So if we go into a project where the business assets do not cover the amount of the loan request, we might need to go out and look at personal assets available to the project as well. Specific sizes, this project can go up to $5 million. It can be up to 90% financing of the total project. So for example, on a $500,000 project, we would have a $450,000 loan, $50,000 from borrower equity coming into the project. One of the benefits is longer term financing. You can typically do up to 7 to 10 years for a working capital loan request, 10 to 15, all depending on the useful life for machinery and equipment, and 20 to 25 years on real estate, again, depending on what we're purchasing. From the bank side or the financial institution that you're working with, they have to really lend just in accordance to how they lend today. They can't be doing anything outrageous with this loan program, even though there's a guarantee behind it. The interest in the projects are going to vary by bank. So if you're talking to your existing bank, they might have an interest in this. And if you're talking to a new bank, they might have an interest. But it would all be depending on how you present your opportunity and what that would be. The use of proceeds, how can we spend the money with the SBA 7A loan program? So to purchase, construct, renovate, or improve, and again, once again, we go back to the owner-occupied concept. We can buy buildings. We can make improvements either in rented space, leaseholds, or capital improvements if you're buying the building and improving it, changing it to the way that you need. Machinery and equipment, business acquisition, and this one where we get into if someone's buying a customer list or goodwill or changing of the ownership of a business, this SBA 7A can finance that. We can lend to working capital, inventory, energy conservation, so if you want to make improvements to your building for energy purposes. And this is one of the few programs out there that can actually refinance or restructure existing debt. And I wanted to go through those line by line because what you'll see as we go forward is this program is the one that has the most flexibility. It has the opportunity to fund all of those use of proceeds. And as we go into future slides, you'll kind of see the other programs are a little bit more restrictive or special purpose to what can be financed. So good project examples, and this is a good one to talk about so you can actually see how they might be being utilized. So challenging industry request, something that might be deemed by a bank or credit union as a higher risk loan project, such as hotel or a restaurant. They might consider those challenging industry, and instead of utilizing the conventional loan or even perhaps declining the loan, they'll look to the SBA 7A loan, have a guarantee behind it, and they have a willingness, that the lender has a willingness to make that risk in their mind of the project. Leasehold improvements with working capital, and I think that's a great example of a franchise. So if you move a franchise into rented space, you want to borrow some money to improve the property, maybe up to the franchise standards. In the case of a restaurant where you're going in, you're making your leasehold improvements, custom changes to the rented space so that you look like every other franchise that you're working into. You could purchase inventory. Again, in that case of that restaurant, you can buy your first order of food, and then you can borrow working capital to ensure that you have enough money on those first days and months as the business is taking off and growing, that you have enough money behind you in case you were to need. Next example, I just use that change of ownership, and where we're purchasing fixed and intangible asset purchase, aka goodwill. So what we'd have here is perhaps a situation like a dentist where we have someone retiring and a new dentist coming in buying the practice, where they're buying all the dental equipment, the chairs, the specialized tools, drills, etc. But then they'd also have the value, if you will, of the customer list. So that business, by being successful over the years, has an intangible, something I can't touch or lien as collateral, such as a customer list and the future ability to do business with those customers. And that's the change of ownership example there. Business expansion is one that projection-based, where on a conventional basis, perhaps the lender doesn't look at that as a real good risk, and you'd have a business that in order to take on the new loan request and the amount that's going to be borrowed, they would actually have to create projections because their historic, whether it be tax returns or financial statements, would not be able to satisfy the debt on the new loan request. And you kind of hear a looking backwards and looking forward situation there. But this is one program that definitely welcomes projections. Obviously, an independent lender decision on how they feel about the projections and their accuracy, and the business's ability to attain those projections. And then the last one is a good example of just a refinance restructure where we can actually extend out the term. So on this slide, a little busy, but if you look to the left here, more in the white box, if you will, where we have a borrower who has 3 separate loans, conventional bank today. They have a real estate loan that's $300,000. It's a 20-year bank term. Just kind of run my cursor over that so you can see where I'm at. Bank payment today of $2,240. machinery and equipment loan of $100,000 on a 5-year basis, $1,960, and a working capital loan of 3 years and a bank payment of $3,070. $500,000 total loan amount, and we have a total payment of $7,300. And what you have here is the situation where now we can take a loan, create just one loan. The SBA is one of the benefits here is taking all those loans, taking the different amortization periods, blending them together, 25, 10, and 7, coming up with an 18-year loan amortization, thus stretching your payments out a little bit more, which we can see right there. And you're going from a $7,300 payment to approximately $4,000 payment. And that difference of that $3,000, $3,000 plus dollars, is about 46%. And to a small business who's looking to improve monthly cash flow, that can be really important. So there's definitely one of the benefits of the SBA 7A loan program. So just a real quick case study where I wanted to kind of focus in on an SBA 7A loan and what an existing manufacturer did with this. So it was an existing manufacturer. They had a mortgage on their building. They owned it. They had equipment term loans and leases. They had older equipment that was in need of repair or upgrade, and they could expand into a new product line. So automatically we go back to what I just talked about was projection-based business, and this is an expansion that way. The total project was to take that existing mortgage debt, some of the equipment loans and leases, not all, combine those all together, purchase some new equipment, get a little bit more working capital down toward that last bullet point in there, where that they would be using to buy new inventory, increase sales, whether it be marketing, and develop the website further. We ended up with a 16-year loan, prime plus 2.75. Important to remember this variable rate. The loan was restructured conventionally in 4 years because with the SBA programs, under 15 years, there is no prepayment penalty on this SBA 7A loan program. So really a benefit there, and this was a good story that the borrower benefited and received what they were looking for, which was a reduced monthly payment, and that they were able to improve cash flow and grow their balance sheet. On to the next loan program. This is called the SBA 504 loan program, and this one we had talked about earlier is whereas the 7A can finance a lot of different loan opportunities, the SBA 504 is strictly fixed assets. It can be either 1, a real estate loan, or 2, a machinery and equipment loan. So it's either a 20-year loan or a 10-year loan. And it has a basic structure here that is a 50%, when I say private sector, for the most part, that is through a bank or a credit union. It can be an individual, private, truly private loan. That lender is in first lien position with a 50% loan to value, which becomes very attractive to that lender, a good reduced risk opportunity for them. Here's the benefit of the 504, and I'm just going to skip right down and I'll come back to the 40%, but because we're in a 50-40-10 situation, that 10% becomes very, very attractive, and it becomes one of the big perks of this program, which is reduced money out of pocket. Now, we'll get into a situation a little bit later where there's an example, and you're talking about the difference, perhaps in some cases, of a few $100,000 kept on the balance sheet, kept on a personal financial statement, instead of put in the purchase of a property. So back to the 40%, second real big perk of this program and advantage. Again, that first 10% equity, less money out of pocket, is your first. The second is on this SBA portion, which is 40% of the total project. It's a below market 20-year fixed interest rate, fixed for the entire 20-year, or in the case of the 10-year loan, 10-year time frame. And what that gives us, especially in these markets and conditions that we're in today, is if or as we start moving in interest rates upward, if you're locked in for the next 20 years on a portion of this project, it becomes very attractive, and it gives you nice peace of mind as far as what you can plan and how you move forward with your business. Total structure, again, kind of akin to the SBA 7A that we had already talked about, where it has a maximum $5 million portion. Here we can do the 40% would be that the $5 million would be that 40% portion, and that equates to, if that's 40% of a total transaction, that would be a $12.5 million project. So even though we say S in SBA is small for Small Business Administration, we can get up to some sizable projects using this loan program. If there is a public policy goal, or for small manufacturers, we can actually get up to $13.75 million for a maximum of $5.5 million in total SBA portion. Now, all of that said is if we're dealing with a much larger project instead of this $12.5 million here, and say we're part of an $18 million project, that's still eligible. The SBA $5 million would be the cap still, but perhaps there's other financing or further equity put in as part of that 10% would actually be more. Just want to go backwards one slide here just to talk about two ways where the 10% equity could actually be required to be greater. One is the case of a startup business, not expansion, where you have an existing business, you do this today, you're moving to a second location for this purchase, and that's where the equity, instead of the 10%, would go to 15% equity. And in the case of a special use property, and a special use is really defined as, think more extreme in nature, a car wash, a hotel, they're not being converted to other uses quickly. Car wash would take a lot of renovation to make into general office space or a warehouse, etc. So think special use. And if it's the case where it's a startup and a special use property, it would actually be a 20% equity, and it would be 50, 30, 20%. This is just an example. I kind of started earlier on the idea of what does this really mean if I get to put 10% out of pocket instead of the traditional 20 or 25% equity out of pocket into a project. So just going down the conventional line column here, on a conventional project, $2 million, we make some assumptions of costs that's associated with the commercial purchase, transfer tax the 1% in the Commonwealth, $2 million total project, 80% bank loan would look like $1.6 million, 20% out of pocket from the borrower yourself would be $400,000, and those costs would actually be out of pocket, $51,500, for a total of $450,000 approximately. In a 504 project, we have $2 million. What we actually do is add those associated costs to make a total project of $2.051 million, which we break out 50, 40, 10%. So I think the comparison is really that, is for the borrower who's looking to retain some capital, either balance sheet or personal financial statement, instead of putting out $450,000 on this $2 million example, you'd be putting out $205,000, and that becomes really powerful if you're going into a building where you have the ability to grow. Let's say a manufacturer, you're able to expand your opportunities overnight almost, and your output becomes greater. You have the ability to sell more product. That $200,000 can go into buying more inventory, hiring another salesperson to go out and make those sales, but that's a lot of money that you can really look at and using and reinvesting in the business in lieu of, or as an option to, putting it into the building for purchase. 504 case study. I think this is a good example here of how we've used this in the past, and a really success story. This is an existing wholesaler. They lease the property long term, and they have the first right of refusal to buy the property that they've occupied. They made numerous leasehold improvements over the last 3 years. It was a sizable project, $9.8 million total purchase price. Required equity on this would have been 10% in this project, but conventionally, which is how they started thinking originally, was going to be 20% equity injection, so almost $2 million. They knew they wouldn't get to the $2 million without kind of harming the business or putting the business in jeopardy if it's cash and working capital. So they found out about the 504. They knew they had the opportunity to put 10% into that, and started saving out of cash flows the $1 million required into the project. What we did in this project was able to, a little bit of flexibility here, and it doesn't always happen, but this was a great success story. We were able to look back and actually take those $900,000 that they improved in the property when they were leasing it, count that as their equity injection, and instead of writing $1 million check, they actually wrote a $100,000 check because this $900,000 was already recognized, and they kept $900,000 on their balance sheet. So this was a really successful story. And in this case, I think it's always a good example is rent versus mortgage comparison. They were actually paying less out of pocket for the mortgage than they were for their rent historically. And then they were up against a rent increase in the next 1 year. So we're kind of proud of this one. The borrower is definitely happy with this, and we had the business vaulting forward. So they were able to buy it and move forward with cash on their balance sheet because we were able to get a little creative with this structure on this. I want to talk a little bit about, and again, we're switching agencies here now. So USDA, United States Department of Agriculture, and don't think all agricultural or livestock loans here, but it's actually the Business and Industry Loan Program. And this is all about more so it's actual business loans, but it's in those that are in rural areas as designated by maps from the USDA, and you can see that down below. It's cities or towns with less than 50,000 contiguous and adjacent areas. Overall, there's maps that we go by, basically look at those and determine if we're in a rural development, yes or no. And we've had situations with this program where you can actually be on the wrong side of the street or the right side of the street, east or west or north or south, that you would be eligible on one side but ineligible on the other. But again, all of these, definitely think about these as a complement or an alternative to lending, and as a result, this isn't for everybody, but where it fits, it really does. This is very much like the SBA's version of the 7A loan program. This business and industry loan program is a guarantee program, 80% for loans up to $5 million, and you can see we get a little bit larger dollar through this program as well. 70%, a little bit reduced guarantee, but significant size projects up to $10 million. There is a tangible net worth calculation that we have to take a look at right in the beginning. This goes back to that communication and expectation slide where we just want to be talking to everyone, make sure we're communicating. We don't want to get a month into the process and realize that tangible net worth or the rural development area is an issue for eligibility. I did include that hyperlink down at the bottom, just that links out to the map itself, and that goes right out to the USDA's website on what is a rural development area. So this one we get into, again, a little bit, many different use of funds, maybe not so much as the 7A, but very close. We can do real estate, now we can do it even longer, up to 30 years on that. Machinery, equipment, same ruling, life of loan, or up to a maximum of 15 years, life of equipment, sorry about that. Working capital goes up to 7 years, and wide array, really wide array. And again, I'm not going to read through those, but overall here, it's different initiatives where we can use this. It's pretty flexible. This is one we want to talk about. We would communicate with the USDA that if it's something that's outside the realm or the norm, we'd work with them and talk and see if it would be fitting and eligible. Government loan benefits, and I think this is an overall slide. We're just taking a couple highlights from the different loan programs that we were working on there and just talking about there. But what are some of the benefits to keep in mind? And really, these are the high level. If you think about these, have an opportunity. These are the ones where you would reach out. If this triggers a reminder, you would reach out, give us a call, talk about this, and let us be a reference and kind of give you some thoughts on that. But these benefits are that really what the programs are there for. We can preserve working capital. If we're doing up to 90+% financing, that's more money kept on the balance sheet or the personal financial statement, but more money in the business rather than in the purchase of whether it be the business, the building, machinery, equipment, etc. Larger loan amounts. I mean, we can really go from projects here from $5 to $13.7 million all the way down to, and they're the high ends there. Some of these programs go down to $50,000, $100,000, can all go down into that size loan. So the scope and the scale of what we can use from borrowing standpoint is really vast here. Capitalized fees and costs. Now, it always has to be appraisal supported where we have the background of the collateral or the appraisal, but where we can add the costs in, that it would be less money out of pocket and more included in the project, we try. Extended loan terms, if we're stretching out the amortization, the repayment longer, payment's going to be lower. And if it's lower and you're looking for improved cash flows each and every month, that would help that out. So we can go from 7 to 30 years, depending on how we're spending the money, what the loan request is for. Long-term fixed interest rates, in the case of that SBA 504 we talked about, up to 20 years fixed. And again, I think as we go into this changing interest rate environment, if we start increasing again and going up to closer to historic numbers, a long-term fixed interest rate that's set today could be really attractive in the future. Blended term or interest rate, we saw that 7A slide if you recall, where we combined into one loan or a two-loan structure, blend the interest rate and the terms together and really come up with a benefit to you as the borrower. And where we can debt restructure and refinance, again, all looking for a benefit to you. Overall, that just kind of wrapped that up there, and I want to make an offer that obviously if you have any questions, definitely reach out to our partners here, and I thank them for inviting me in at the Northeastern Pennsylvania Manufacturers and Employers Association. And again, my contact information on the slide there, please feel free to visit the website, call me directly, or drop me an email if I can ever be a resource for some of these government loan programs or overall for small businesses. Thank you for your time. Have a good day.